Okay, welcome everybody to today's webinar, everything you need to know about paying benefits from an SMSF. The title, as I contemplated this webinar, I recognised that maybe an hour is not sufficient time to be able to go through everything we need to know about paying benefits from an SMSF. So I'm going to try and cover off as much as I can in the time frame to provide you with as much information as you need. And for a lot of it, it's going to be hopefully refresher information for you. But I think the key is that, you know, we work through the stages of the superannuation life cycle, and paying benefits is clearly a part that can apply throughout that the entirety of the life cycle. It's made a lot easier, particularly once we hit retirement and move into the pension paying part of the cycle. But there's other key things that occur along the way that we want to get right. And if we get things wrong, we want to know what the consequences are. So we'll work through as much of that information as we can today for you. So standard disclaimer applies. I'm really hoping that that nothing happened in the superannuation landscape in the few weeks that I was away. I'm pretty sure that that had something have happened, my email alerts would have gone crazy in that time. So certainly in this benefit payment space, I think we're pretty safe to proceed as expected. So we're going to talk through the conditions of release, the types of benefits that we can pay, the taxation of those benefits, and anything associated with the early release of superannuation as we go through it. So where I want to start with is, I guess, a bit of an overview as to the whole access element and preservation, and then the various conditions of release, and then build on some of the key issues there. I'm not going to spend time on every condition of release today. I'm going to focus a little bit in on some of the key definitions around some of the, obviously some of the regular ones, such as retirement, which is a critical one there, but also sort of drill into a little bit things such as terminal illness, financial hardship, and permanent incapacity, because, you know, they're sort of quirkier kind of conditions of releases that have some specific issues associated with them when we're looking at trying to access super in those areas. So we'll touch on those in a little bit more depth than perhaps some of the other conditions that we will discuss. So what we know is superannuation is effectively entitled to tax concessions, all based around this concept of preservation. So we put money into superannuation, we are given tax concessions associated with that. So we know that the earnings of the fund are taxed at a maximum of 15%, the income of the fund taxed at 15%, subject to that money being preserved or held without access until our retirement. That's the concept behind the tax concessions and preservation. And for those of us that have been in the system long enough, dating back to pre-1999, and of course I certainly fit into that category, we know that the rules since the 1st of July 1999 have been pretty stock standard. Everything, all contributions and all earnings from that date are now preserved components, and they're preserved until a condition of release is met with a nil cashing restriction, and then those benefits are changed to unrestricted non-preserved. But before that date, we had this concept of restricted non-preserved, and they are often related to employment-related contributions. Now, they will still exist if they have been rolled over since 1999 and not accessed in other sort of circumstances. And then our final one is our unrestricted non-preserved, which are benefits that we will have where we have satisfied a nil cashing restriction condition of release. So preserved, that's our number one componentry that we'll see for all monies going into super. Restricted non-preserved, limited sort of position in the industry these days, and then unrestricted non-preserved is when we've got full-blown access to our super components, our super benefits, and we need to meet a certain condition to do that. One thing I'll say sort of straight off the bat here with regards to preservation and the preserved component, when we're looking at, and today I'll be focusing quite a lot on the lump sum side of things from a taxation point of view, when money is sitting in accumulation and we meet a condition of release, If we don't move across to pension stage, then the money remains effectively the money that we unrestrict by meeting a condition becomes unrestricted, but every earning from that day onwards will then take on the preserved component again. So, the question I get asked quite regularly in the space of lump sum withdrawals is, once I've met a condition of release and I access the money, can I keep accessing my money without any need to restate the condition? Well, the answer to that ultimately comes down to how much have you taken out? Because if you've taken almost all of it out, or all the money that was preserved at the time that you met the condition, then any growth since then is going to be preserved. And to access that money, you will have to re-meet the condition of release. And I'll touch a little bit about that when I'm talking about disability again shortly. But I think it's one of the critical things that if you move into pension phase, so if you've met nil cashing restrictions, move into pension, then all of the assets will become unrestricted, non-preserved, and all earnings will be unrestricted, non-preserved. But if you retain your money in the accumulation interest, then all earnings will continue to be preserved and will continue to be taxable component. So when you've satisfied a condition of release, then your benefits are going to be taken out in the following order. Now, I've deliberately not said a nil cashing restriction condition of release, because everything will be unrestricted, non-preserved in that circumstance. But when you've met a condition of release, and the obvious one here is, say, attaining preservation age. So when you hit age 60 now, the money comes out from unrestricted, non-preserved first, then it will come out from your restricted, non-preserved benefits, and then it will come out from the members' preserved benefits. Now, that's obviously in direct competition or in opposition to when the benefit is growing. Because if you, as I said before, if you're in accumulation and you take unrestricted money out and then the fund grows, or that money grows as preserved money. So it's something that's at least worth keeping in the back of your mind when trustees / members ask the inevitable question around financial statements is, I had some unrestricted money, I've taken it out, and now all the money is becoming preserved. What's the consequence of that? Well, withdrawals come from unrestricted first, and then growth from an income point of view will be allocated back to a preserved component. So understanding that is a key piece to fund administration. And then we look at the key to access, and the key to access is preservation age. And for many of us, for many years, we've had to calculate how old is somebody, what's their date of birth, what is their preservation age going to be. For everybody now, our preservation age is 60, right? So 60 is pretty comfortable from a conversation point of view. It's also comfortable because when we start to talk about things like taxation, all accessible money, right? So once we've met that condition of release, all accessible money is treated as non-assessable, non-exempt income, so we pay zero tax on it. So 60 and above, we know since 2007, is effectively a tax-free haven from a withdrawal point of view. It's only other circumstances pre-age 60 that will determine a various level of tax that needs to be paid on the components, or in certain circumstances, death benefits. But we'll touch on that as we go through. So let's look at accessing super. What are our conditions of release? So I haven't put every condition of release on here. I've put every condition of release as it generally applies to a self-managed superannuation fund. So we'll work through these, as I said, in different stages in today's webinar. We've got our temporary incapacity, attaining preservation age, death, retirement, permanent incapacity, turning 65, financial hardship, and terminal medical conditions. Those, whatever that number is, those conditions that I've just stated, they're all determined by the trustees of the fund, okay? So in an SMSF environment, the member or the member will apply to access their benefits, and the trustee will need to make an assessment whether or not the money or whether or not the member has met the appropriate condition of release. First Home Super Saver Scheme, I've chucked that in there, with that along with release authorities, because they're kind of tax office driven in the sense that for First Home Super Saver, you have to make contributions and then you apply for release to put down a deposit on a home, a first home, and so that's a release provided for by the tax office. really it's its own subject matter for us to go through another time. Release authorities, again, when you've got excess contributions, when you've got Div 293, potentially with Div 296, who knows what's going to come about with Div 296, where you've got a release authority. Again, it's something issued by the ATO for the member to make a decision whether to leave money in super or to take money out of super. And when they take money out of super, again, dictated by the ATO, you then follow that release authority. Compassionate grounds is the only sort of member event condition of release that needs the authority of a regulatory figure. The regulatory figure has changed over the years. We've seen APRA involved in it. We've certainly seen others prior to that involved. The Department of Social Security, I know that's not what they're actually called, family services or whatever, involved in it. But now from a compassionate grounds point of view, if a self-managed super fund member wishes to apply, they need to apply via the tax office. So when we contemplate compassionate grounds, we are actually not in the position as trustees to make a decision on that. It's going to be up to the regulator to determine whether or not the condition has been met. And then it's up to the regulator to determine how much can be released. And there's certain situations that'll determine how much, like if it's to do with mortgage repayments, it's going to be like 3 times the payment or whatever it is, or 3 months worth of payments. If it's for medical conditions, then it's going to be based on what your expenses are going to be. And this is for releases when you know what the expense is, but you haven't paid for that expense. So you're effectively claiming it in advance once you know the amount. So we're going to look more broadly at the ones that are in the trustees' control as part of today's session. And the first one, which I guess is the key one, and is a significant one that has changed because preservation age has moved to 60. So with the movement from 59 to 60, or from 355 all the way through to 60, retirement now is a lot more clear cut, because there's basically 2 conditions that we can meet, and a lot of it is going to come down to when you have terminated gainful employment. So if you've reached preservation age but you're under 65, then you can retire based on the concept of ceasing gainful employment, right? So we know that gainful employment is being employed or self-employed for gain or reward in any business, trade, profession, vocation, calling, occupation, or employment. And then you've got the concept of part-time and full-time. And importantly, when we're looking at retirement, the definition of part-time is where you work at least 10 hours a week, but less than 30, right? So above 30 is considered full-time. So therefore, to be gainfully employed, you've got to be working at least 10 hours per week, which means when we then jump into the definition of retirement, right, to cease gainful employment means to reduce hours below that 10 hours per week. So it doesn't mean that you can't work at all. It means that your time limit, your weekly time limit, is diminished to below that 10-hour period. And so there's effectively 2 options that can be met once you've attained preservation age to meet that retirement condition. One, you can cease gainful employment and make a declaration where you have no intention of being gainfully employed again in the future. So regardless of when you cease work, but there is a requirement to cease work, regardless of when you cease work, if you make a future intention declaration that you intend not to be gainfully employed again, then you can meet the definition of retirement. Alternatively, if you cease gainful employment after attaining preservation age, so after turning 60, then the cessation itself will allow you to meet that retirement condition, and any future employment scenario is irrelevant to that retirement piece. Now, what that actually means is that, and this is a question that many of you may have been asked and may have asked yourselves in the past, if you've got multiple gainful employment, multiple gainful employment arrangements, then you can cease one of them, and that will be sufficient for you to be able to access your benefits at that point in time. So that can be relevant in differentiating between, say, a transition to retirement income stream and a standard account-based pension, is if you can cease a gainful employment arrangement and have unrestricted non-preserved benefits, then of course you can do a lot more from a pension point of view than if you just attain preservation age and start a TRIS where you've got your 10% maximum restriction, but also you've got greater problems if you fail the pension standards. So two conditions there. If you retire at any age, or if you cease gainful employment at any age, then you can make a future employment declaration. If you cease gainful employment after age 60, then your future intention isn't relevant. And I've got an example there of Mary that you can sort of work through to say, okay, well, Mary turned 60 in June. If she ceases with her current employer, then she can access her, if she ceases after her 60th birthday, then she can access her superannuation benefits. If she had have ceased before the 20th of June, then she would have to make a declaration of future intention from a retirement piece. So it's one of those areas that you also want to make sure that it is a genuine cessation of employment as well. So there's a lot of case history in regards to that, and to go through the various nuances is we don't really have time in today's webinar. But if you're looking at people where they change their arrangements within the one company, there can be problems in regards to that, changing from, say, self-employed to being a director, being an employee, and then changing the structure and going from a company to a trust arrangement, or a company to a sole trading arrangement. You really want to be careful there, because all it takes is the ATO to want to undertake a review of the situation to determine whether or not you are actually accessing preserved benefits versus unrestricted non-preserved. One of the other conditions of release that I think is always valuable to highlight before we start talking about the taxation consequences is the condition of permanent incapacity. Because under permanent incapacity, which is the CIS condition of release, it uses the following language. It says, a trustee is reasonably satisfied that a member's ill health makes it unlikely the member will engage in gainful employment for which the member is reasonably qualified by education, training, or experience. Okay, now the first thing there is it talks about the trustee being satisfied. So there's no reference to medical certification or anything. It's just the trustee's position. Of course, that's a little bit risky in a self-managed super fund if the trustee and the member are the same person, that you're making a declaration that due to your health, you're unable to work in the future. Now, the other change that's occurred over probably the last decade in this area is permanent incapacity used to talk about that the member is unlikely to ever again be gainfully employed. And those words have been removed because it really didn't provide for the ability for people who had yet started to work. So if you had, say, an adult child or whatever who had finished their studies and was about to go to work and then was injured in an accident, well, they could get, or they would be permanently incapacitated, but the wording of the legislation was a little bit restrictive. So that ever again piece has been removed, and it just talks about inability to work to your required training sort of standard there, versus a superannuation disability benefit. Now, superannuation disability benefit is really linked to the taxation of the benefit and the ability to hold insurance proceeds inside a superannuation fund. And to access your super under a tax concession environment, and really let's call it what it is, an audit-free environment. Like, you're not going to come under any scrutiny if you meet the definition of a super disability benefit, and that requires two legally qualified medical practitioners to certify that because of the ill health, that the member is unlikely to ever be gainfully employed in the capacity for which they're reasonably qualified because of education, experience, or training. So the definition piece is the same. Who defines it is different in disability versus permanent incapacity. So by getting those two legally qualified medical practitioners to sign off, then it makes the world of the trustee a lot easier for them to sign off from a permanent incapacity point. And definitely from a taxation position, you're going to need those two certificates. So it's a key area there. The next one is the terminal illness condition. And this has changed again over a period of time, where it used to be a 12-month period to a 24-month period. And again, this requires the two registered medical practitioners, one being a specialist in the field of the illness or injury, but they have to certify jointly or separately that the person suffers from an illness or has incurred an injury that is likely to result in the death of that person within a period, which they call the certification period, that ends not more than 24 months after the date of the certification. Right. So under this terminal illness condition, you do need the certification, and the certification must state that ultimately that the death of the member is impending. And if you meet that condition, then clearly the taxation situation changes quite significantly for the individual, and we'll talk about that. So they're the key sort of conditions of release, and there's a couple more that I will run through. But then what I want to highlight is those with cashing restrictions and those without cashing restrictions. So once you've retired, there is no cashing restriction. You can access your full benefits. Terminal medical condition, you can access your full benefits. 65 is obviously still the number one condition of release for most people, because if people are working longer in life, so working sort of beyond age 65, 65 is still the golden age of access for being able to get full access to your superannuation. So it's still the one we all target nicely there. Permanent incapacity gives us full access, and of course the death of a member gives full access to the beneficiaries of the member. And death is also the only compulsory cashing requirement, which is where I always tend to get into my little sort of, I guess, soapbox moment around superannuation and the sole purpose test, all of the various things such as, whether we're talking about transfer balance cap, all sorts of other areas, is that death is the only mandatory compulsory cashing requirement, which means that people can actually retain money in super beyond age 65. However, that's in direct competition. My opinion has always been it's in direct competition to the sole purpose test, which is the purpose of superannuation is to provide benefits upon retirement or upon turning 65. So even the introduction of the transfer balance cap for me has always sort of, it triggers me, right? Let's be honest. It triggers me because the transfer balance cap says you can only put right now $2 million into to super, right, to be entitled to be able to pay a pension. So if you've got more than 2 million in super, that money can sit in accumulation. Well, from a sole purpose test, you're meant to be paying a benefit with all that money. So why are we restricting how much you put into pension? So the anomalies created by tax law, such as ECPI, are in direct competition in my eye, right, when it comes to things such as the sole purpose test and the requirement to pay benefits out. All right, soapbox moment ended. All right, just one of those kind of key issues there. Cashing restrictions. You are limited in what you can take out if you're taking money under temporary incapacity, compassionate grounds, under the release authorities, which are quite specific, same with the first home super saver, and attaining preservation age. Now, attaining preservation age has a little bit more flexibility than each of those other ones. So temporary incapacity, release authorities, first home super saver scheme, and compassionate ground, it's going to be a very specific amount of money that you can actually take out of the superannuation system. Attaining preservation age is our roadway to TRIS, transition to retirement income stream, which gives us capacity to access between 4 and 10% of our account balance in the form of an income stream. No tax restriction or no tax benefits associated from an ECPI point of view, but massive tax benefit for a member's point of view because they're over 60 now, they're 60 or more. So it's non-assessable, non-exempt income. So, attaining preservation age is a very good condition to satisfy because you can get that access. You're not paying any tax on the benefit, but yes, the fund will still pay tax. Of course, it's critical then that you take between that minimum 4% and that maximum 10% to ensure that you don't fall foul of the pension standard requirements. So if you fall foul of the pension standard requirements, the commissioner will say you don't have a pension. And if you don't have a pension, they'll say that you've accessed lump sums. And if you're in a transition to retirement, then you've accessed preserved benefits, and that sends you down the slippery slope of what we're going to finish off today's webinar, which is that early access to super componentry. So they're your definitive yes cashing restrictions and your definitive no cashing restrictions. And then sitting in the middle of all that is financial hardship. Now, financial hardship for many of us is a condition that doesn't come around all too often, right? But it is a condition that is applicable for those who are in receipt of Commonwealth income support, right? And if they've been in, so if they're under preservation age and they're in receipt of Commonwealth income support, and they've been in receipt of that support for a period of 26 weeks, so for those doing the maths at home, basically 6 months, right? Then they can withdraw between $1,000 and $10,000 as a single lump sum in a 12-month period, right? So single lump sum between $1,000 and $10,000, 12-month period, but being mindful that in most circumstances, if that's coming out of a taxable component, these individuals are going to be under preservation age, and so therefore they're going to be subject to tax. And so the 1,000 or 10,000 is likely to be less, 20% or 22%. Now they might get that amount back subject to what their other income requirements are, but it's incumbent on the fund to register for PAYG and to withhold that amount from the withdrawal. Now, the reason I put it in between the yes and no from a full cashing requirement is if the member is after preservation age, and realistically, we're talking about someone that's probably 61, because if they're after their preservation age and they have been in receipt of Commonwealth income support for a cumulative period, so not consecutive, but a cumulative, I'll get that word out in a moment, period of 39 weeks after attaining preservation age, then the 1 to 10,000 restriction is removed and they can access all their benefits. So there's a financial hardship change once you've attained preservation age. But of course, you know, the question often arises for me is why are you accessing your money under financial hardship once you've hit preservation age when you can ultimately access 10% in the form of an income stream if you go down the TRIS path. And in many instances, it might be because if you are drawing income elsewhere, then your access to the Commonwealth income support might be actually removed. So it's one of those quirky areas, but just knowing that once you've hit preservation age, if you've been in receipt of income support for a combined period of 39 weeks, then you can access all of the benefits from a superannuation point of view. My caveat to that is in however many years I've been doing this, let's call it 25, in the self-managed space around that mark, I've never once seen anybody access financial hardship benefits post preservation age. I've certainly seen numerous occasions where it's been done beforehand. And ultimately in that situation, you've got to also provide your access to why you're in financial hardship, what sort of payments you're needing to meet, so the trustee can make that decision. I've kind of always been, like I talk about with compassionate grounds, there's been movement and there's been conversations held at government level about whether or not financial hardship should also be signed off by the regulator versus the trustee. But right now it sits in that trustee scope based on the provision of the necessary evidence, which is the Commonwealth government support evidence that you need to provide. Then the final piece of the access one is, how do we access our money? Like, what can we take as a lump sum? What can we take as an income stream? And what is there really ultimately no restriction on? Well, our release authorities, financial hardship and compassionate grounds, they're paid out as lump sums. Our temporary incapacity and our attaining preservation age, they are paid out as income streams, right? And whether those income streams are monthly, annually, whatever, they're still considered to be an income stream. And then once we hit retirement, 65, medical condition, permanent incapacity or death benefits, then we can either pay the benefit out as a lump sum or as an income stream or as a combination of both. So we've got the options available to us there to do that. So when we look at the payment types, so if we break it down into obviously our lump sum and our income stream payment types, then there's a little bit to do with the trust deed and ensuring that the deed provides for what we're going to do. And one of the things that that's always been I guess, a fascinating conversation piece, and maybe that's a bit of a stretch to call it fascinating, but an interesting conversation piece right from the dawn of time, and that is the concept of individual trustees versus corporate trustee. And the individual trustee piece was that the individual trustee has the power to pay the pension. And so forever there's always been this faux argument that if you have individual trustees that the fund can't pay a lump sum benefit. Now, the tax office came out pretty much prior to me getting into the industry. So over 25 years ago, the tax office's position has always been clear that individual trustees can pay lump sum benefits, but the primary purpose of the fund has got to be for the provision of the pension. So our objective, and that's a link back to the Constitution, right? But the purpose of the fund has got to be to pay the pension, but there is no restriction on paying lump sums unless your deed puts a restriction in place. And I've seen historically deeds in that situation, but most deeds now provide for both. How you pay a benefit is then quite specific when it comes to lump sums versus pensions. And a lump sum benefit, whilst largely these are paid out in cash, they can also be paid out as an in specie payment. So whether it's a benefit to the member or whether it's a benefit to beneficiaries following the death of a member, you can actually transfer the assets of the fund out as that benefit payment. Of course, market valuation is critical there, ensuring that that the market valuation is representative of the commercial transaction that should occur with regards to that asset. So listed securities, pretty simple with regards to that, obtaining what the valuation is at the date of the payment. From a property point of view, ultimately getting a valuation undertaken from a fund point of view. One, because you've got to look at things from an arm's length transaction point, so ensuring that the fund is always dealing on an arm's length basis. But also you've got to fairly and accurately represent your capital gains tax position there for calculating CGT. So if you're accessing money before the fund is in pension phase, you want to make sure that that you are appropriately recording for CGT purposes. So yeah, so in the example there, Claire's got $50,000, and so she wants to transfer the ABC shares out of the super fund. She can actually do that from a valuation point of view. And we do see this situation arising a bit within the industry. For me, often the scenario of doing in specie lump sums versus selling down the asset and then re-entering the marketplace is a bit of a muchness situation, because ultimately, because you are going to reset the CGT position, with the exception of, say, relationship breakdown, where you're going to move the assets and the cost base will move with it. In every other circumstance, you're going to reset the cost base for CGT purposes. So, does an in specie transfer provide any real benefit? Potentially, the benefit associated with it is brokerage from an investment point of view. But then whoever's undertaking the work from an in specie piece, they might have a fee associated with that. So weighing those sorts of things up will determine whether or not to pay the benefit as an in specie or a cash payment. But when we talk about cash payments, pension payments must be paid in cash. Okay, so when we choose to access our benefit as an income stream, then we have to go through the process. And again, today's webinar isn't really talking through the concept of pensions, because that's, again, its own subject matter. We've spoken about that in recent webinars. You can always visit the SuperGuardian website to look at their past webinars, the recordings of the past webinars that are up on their site there. And so a lot of the issues associated with pension you can go back and review. But what we do know is that if we're starting an income stream, we're creating a separate interest within the self-managed superannuation fund. We are also determining the proportions of the benefit from commencement. So at lump sum stage, one of the things that I didn't say on the previous slide was at lump sum stage, we have to calculate the proportion of tax-free and taxable immediately before the lump sum. So every time we want to do a drawdown, we have to factor in any growth and how that's going to impact the taxable component, because our tax-free amount is effectively a fixed amount that as a percentage will diminish or increase based on the movement, the growth of the fund, or the decrease in the asset values. So you have to do that proportioning each time. Whereas a pension, we do the proportioning at commencement, and then that proportion applies to every pension payment, every commutation that we take, and then the final death benefit. And the only change to that is when insurance proceeds form part of the death benefit, and the payment was a non-reversionary. But again, we talked about that in a previous insurance webinar. So let's look at the taxation side of things, because taxation is, you'd think, relatively straightforward, and the outcome in most circumstances is pretty straightforward, but there are different circumstances that result in different tax outcomes based on the condition of release that has been met. So when we're talking about tax on lump sums, then probably the key thing is, well, obviously the components, tax-free components are non-taxable, but the taxable component, which in a self-managed super fund is largely going to be a taxable component with a taxed element, right? But occasionally, very, very rarely, but it does exist, we might have a taxable component with an untaxed element, and that will change the taxing dynamic. But the benefits are generally going to be taxed based on the age of the recipient, being the member or the beneficiary. And so it's clearly important to understand what we're paying, so paying a lump sum, who we're paying it to, the member or the beneficiary, and how old they are, and what are the circumstances associated with it. So if we look at it from a standard point of view, anybody who's receiving any member who's receiving a benefit who is 60 and above, right? So we know that the tax-free component is tax-free. It's all going to be non-assessable, non-exempt income, so no tax is payable, right? Very simple. Whether it's pension, whether it's lump sum, if you met your condition of release and all your money's unrestricted, non-preserved, no tax to pay. Very comfortable with that, which also means that when people fail the pension standards, if it's an account-based pension, the drawdown considerations are really a moot point, because it's still non-assessable income. It's when you've got TRIS issues, and it's when you're looking at the ECPI position of the fund, then pension versus lump sum withdrawals become more of an issue. Now, if somebody is below their preservation age, so somebody's under the age of 60, then the taxable component is subject to 20% plus Medicare. And this is generally going to apply where you've got compassionate grounds, financial hardship, or permanent incapacity, right? So the release authorities are subject to no tax, because they've normally gone through let's say an excess contribution or a Div 293, and they are often a tax liability in themselves. And so that's a different taxing regime. And similarly with the first home super saver, it's its own separate little beast there. But when we're accessing money under these other conditions, compassionate grounds, financial hardship, and permanent incapacity, we're going to have a 20% liability plus Medicare on the taxable component. Terminal medical condition, the entire benefit, whether it's tax-free or taxable, inside that 24-month certification period, is going to be non-assessable, non-exempt income, right? So the money becomes unrestricted, non-preserved. There's no need to report it in the personal return. Now, the one interesting one of these is permanent incapacity, because, as I said before, when it comes to permanent incapacity, there's the SIS definition, the permanent incapacity definition, and then there's the tax definition, the disability super benefit. So when we've got the insurance proceeds potentially coming in, right, you're generally going to meet the permanent incapacity condition, and the insurer is going to pay the proceeds into the superannuation fund. If the members satisfied the incapacity definition from the SIS regs, then the benefits can be paid out to the member. And if we pay the benefits out to the member and it meets the definition of a disability superannuation benefit, so incorporates those 2 medical certificates, then we would have the taxable component at 20%. However, we've got the capacity to also modify the member's tax-free component and increase that amount, decreasing the taxable component. So whilst we're still paying 20%, we get this modification calculation, which means we're actually, based on the future portion of the benefit, we're replacing the taxable component of that with a tax-free component, and then we're adding it to the standard tax-free component that we would calculate to get an end position for the fund. So with permanent capacity, from a lump sum point of view, there's some additional calculations to be done subject to us meeting that definition of a disability superannuation benefit. So they're the main sort of situations for member benefits that we receive. We've then got our death benefits, and again, the key here is who is the benefit being paid to. Now, this is not who can the benefit be paid to, because that's a SIS decision. So the SIS Act will determine who we can pay benefits to. The Tax Act will then determine who is a tax dependent for death benefit purposes. And this is where you obviously go through your standard, your spouse, your child under the age of 18, your child who is under 25 and financially dependent, or your child who is suffering from a disability. They are tax dependents. Then you've got your interdependency relationship, and then you've just got your core financially dependent person. So you've got to work through the various conditions of each to determine if the beneficiary is going to be a tax dependent or not. And if they are a tax dependent, then the entire lump sum benefit is going to be tax free to them. If they are a non-tax dependent, then they're going to pay 17% if the benefit is paid directly to them, 15% if it's paid by the estate, but 17% on the taxable component, and 30% plus Medicare, so 32% on any untaxed element. Now, untaxed element is a rarity in the SMSF environment, but it will occur if the proceeds being paid out to the beneficiary incorporate insurance proceeds, and the super fund has claimed a tax deduction on the premiums linked to those insurance proceeds, and the deceased was under the age of 65. So one, there's got to be a death benefit. Two, the deceased had to be under 65. And three, the fund had to claim premiums or claim a deduction on the premiums or on a future liability to pay benefit deduction. And if you meet all those conditions, then there's going to be an untaxed element. But it's very rare. It's a very rare set of circumstances that an untaxed element is calculated on a death benefit paid from a self-managed superannuation fund. So when it is, you just need to understand that and be prepared to take on the appropriate tax calculations. From an income stream point of view, again, 60 and above, non-assessable, non-exempt income. So it doesn't matter if it's transition to retirement income stream, doesn't matter if it's an account-based pension, right? Then we've got no tax to pay on that income stream. You know, I haven't focused here on our cap defined benefit income streams. I think we've done a lot of webinars on that recently with regards to the capped income stream and the additional tax there. So if we're moving beyond the scope of legacy pensions into a standard environment, then anyone 60 and above is not paying any tax on their withdrawals. If you're withdrawing benefits under preservation age, right, then you're going to be paying marginal tax rates. And ultimately, there's going to be 3 situations where you're going to receive benefits under preservation age and be subject to the concept of the marginal tax rate. And in 2 of those circumstances, a 15% tax offset is going to apply. The first one is for a member under the age of 60 who is in receipt of a disability super benefit income stream. So if we meet that permanent capacity and then we subsequently meet that disability superannuation definition, then the income that we draw down, if we go to pension, we don't get the modified tax-free calculation, but we do get a 15% tax offset on the income that we're drawing down. So the fund would need to register for PAYG. Again, the other side of disability is that the fund itself will get the ECPI deduction as well. The next one is when there is an income stream paid following the death of the member. Now, firstly, if the member was over 60 when they died, there's no tax to be paid. If the beneficiary is over 60 when the member died, there's no tax to be paid. If both the member and the beneficiary were under the age of 60 when the member passed away, then there will be tax. on the taxable component, it will be marginal tax rate, but you'll be subject to the 15% tax offset. So again, it's a matter of understanding the circumstances at the date of death to determine what the end outcome is for the fund from a taxation point of view and for the member from a tax withheld position. And of course, when there is tax to be withheld, the fund needs to register for PAYG requirements. Now, I said there were 3 circumstances because the third circumstance is that of temporary incapacity. Right, so temporary incapacity is effectively our income protection. Right? Now, if somebody's got income protection and they're holding that in the superannuation fund and they're doing it maybe for cash flow purposes, because temporary incapacity is deductible outside of super as well. So it's the one insurance that is deductible outside of super. But if it's held inside of super and the proceeds get paid into the superannuation fund and then distributed out to the member, then those proceeds it's effectively, I like to liken the super fund as effectively just a funnel, right, where the insurance money comes in and gets paid out. And so it is just normal assessable income. The fund is not entitled to exempt current pension income. The income is taxed at marginal tax rate. There's no 15% tax offset or anything like that. So it's just effectively a secondary PAYG arrangement where effectively the super fund is paying directly to the member after receiving the proceeds from the insurance company versus the insurance company paying it directly to the member. So income protection is a different set of income stream. It's a non-commutable income stream, so you can't take access out. It's only payable up to the period of incapacity from employment. But importantly, for those that don't have insurance inside the fund, you can't actually access the member's benefits to pay out a benefit under temporary incapacity. Now, to clarify that point there, what it means is that money that goes into super is considered to be a member's minimum benefit. So any contribution that goes in is a minimum benefit, and any earnings on those contributions are minimum benefits. That's set within the SIS regulations. From a temporary incapacity point of view, or sorry, from an access point of view, condition of release point of view, when you meet a condition of release, you can access your minimum benefits, right? And so therefore you can access all of your super components. With temporary incapacity, they restrict that and they say you cannot access those minimum benefits that are a member's member finance benefits, right? So our members' member finance benefits are all personal contributions and any earnings on those personal contributions that you make. Also, you can't access a member's mandated employer finance benefits. So super guarantee, industrial award super, and any associated earnings on that, they cannot be touched in the circumstances of income protection. But it does leave one final component of super that is accessible under temporary incapacity and might be of assistance when paying out benefits to someone who is temporarily absent from work. And that is non-mandated employer finance benefits. So things such as salary sacrifice are not mandated, right? They're an agreement between the employee and the employer to put contributions in. Because they're not mandated, right, they don't form part of the minimum benefit restriction for temporary incapacity. I always just like to highlight this point so that people know that generally rule number one is you've got to have an income protection policy in place if you want to be able to pay benefits out of your super fund. However, if you don't have an income protection policy or you do have it and it doesn't fund you up to the income that you would normally receive from prior to incapacity, then if you've got non-mandated amounts, then they can be paid out. The issue is a lot of the times non-mandated amounts are not recorded separately within the reports of the fund. And so it might need some other form of tracking. It could be that the fact that you've got your reportable employer super contributions as part of your annual PAYG statement from your employer, that amount generally excludes your mandated stuff. So you can get an idea as to what your non-mandated contributions are from the annual report provided from your employer. So that temporary incapacity one is just a key one to highlight some of the important considerations. What I want to finish with now having gone through sort of when we can access the money and the differentials between some of the key taxation situations, is I wanted to talk a little bit about the tax office position. Because there's really two sort of situations that are arising here. And I'll touch, as I discuss all this, I'll touch on the concept of illegal early release, because illegal early release really comes down to one of two things. One, you've ripped money out of super, right, because you have no consideration for the law, and you just see it as a big, large lump of money, and you're going to access it for whatever purposes, right? That's illegal early access, and that's in itself a totally different scope to paying benefits from a super fund. You've got sole purpose test issues there. You've got financial assistance issues there. You've got a breach of the payment standards there. So you've got a world of super compliance issues to deal with, all sorts of various penalty regimes that can apply in that sort of scenario, and penalties that can apply for those promoting such schemes. So of course, that's a number one position from a tax office of what they are trying to fix. And they see that part of our industry tries to fix illegal early release by identifying those amounts as loans. But interestingly, at the SMSF Association conference earlier this year, the Commissioner's representative said, well, a breach of the benefit payment standards is subject to effectively the operating standards, and the admin penalties of the operating standards are lower than the admin penalties for loans to members and relatives. So where people are recommending they overcome illegal early access by calling it a loan, you're actually putting yourself in a higher penalty breach regime than by illegal early access. And so you've got taxation consequences to consider there, but you've got further investment restriction considerations by going down the path of a loan that is not a legitimate loan. And we know that you can't do loans to members or relatives. So it's a key issue there. So what the tax office have done and what the tax office are doing is, firstly, we've got our TR 2013-5, when a super income stream commences and ceases. We've done a webinar on that, so I'm not going to focus too much on it, other than to state that it's the breach of the pension standards that I think in many circumstances are going to result in people having illegal early access because they're, say, in a TRIS, and therefore the money is coming out as a lump sum. So if we get our pension standards right, if we meet our minimum requirements, we're going to offset a lot of the issues associated with early access and the potential tax consequences that comes with early access. We then had the Commissioner releasing TD 2021 D6 and PSLA 2021 D3. So these documents were released together, and they were ultimately talking about the Commissioner's position both internally, which is the PSLA, so that's their policy piece, internally how to deal with illegal early release, and the TD 2021 was really an announcement to the industry when and where the Commissioner might apply discretion with regards to the treatment of breaches to the payment standards. So what we have is, if like the taxation, all the elements that I've highlighted for you before are effectively found under Division 300, I think it is, of the Income Tax Assessment Act. And so generally the 15% tax rate, all those sorts of things apply. And then effectively there's the final area there, which is subsection 304. And within subsection 304, it says, if payments are taken out that aren't taken out in accordance with all these other areas, then that amount is going to be treated as normal assessable income, but it gives the Commissioner the capacity to apply their discretion. And realistically, what they're saying is that the circumstances in every situation that's going to dictate how the Commissioner will apply it. So my position always when talking to industry representatives, i.e. the trustees or the SMSF professionals servicing those trustees, is if you start from the worst case scenario and then work backwards, then you're in a better position from understanding what the outcome is. So the worst case scenario, exclusive of penalties, is that if you take money out of super early, then you are going to pay marginal tax on that amount, right? So it's not going to be treated as a tax-free taxable, it's just going to be taxed as assessable income, and you're going to pay marginal tax. Worst case scenario, right? Plus penalties, but the penalties are more on the trustee side. So there might be some tax issues there, but the penalties are going to generally be lumped on the tax-free side. But if the commissioner chooses to use their discretion because of the circumstances around why the money was illegally accessed or accessed early, then they might still treat the payment in accordance with all of the taxation considerations that I've just provided. They might say, okay, we can still treat that amount under these normal set of circumstances. So that's from a membership point of view. But then from a trustee point of view, you've got to contemplate the decisions you're making as trustee to pay benefits out. And if you have deliberately paid benefits out early, then you're going to be subject to the admin penalties, potentially disqualification, and potentially, depending on how significant the breach is, other financial or other penalties associated with the fund. And we've seen it in a number of cases recently where people have been disqualified for acting as trustee because they've been paying benefits out over a number of years, clearly in breach of the legislative objectives. And so these guidances, these two documents that I highlighted before, TD 2021 D6 and PSLA 2021 D3, they were introduced to help us through these situations. Now, the problem is they're on hold, right? So we're in this state of flux now where we've got a pseudo position from the ATO that says everything will be treated as assessable income. We've got a draft set of rules that say there are circumstances where we won't treat it as assessable income, but those documents have been sort of withheld pending other priorities within the ATO. Now, as an industry, we hope that those other priorities include the finalisation of tax ruling 2013-5, which was the pension ruling, which was finalised 12 months ago, because that opens up the gateway to be able to then finalise these other documents that help us in a situation, particularly where someone in a TRIS has failed to pay the minimum pension, but therefore drawn out amounts that represent, let's say, 4% of the account balance, and they're being told to treat these amounts as lump sums, not pension payments, but then those lump sums would be considered to be normal assessable income, but also would be considered to be early access. And so what is the commissioner's position going to be? So if we tell people that it'll be treated as normal income and taxed at your marginal tax rate, that might be the best outcome, right, in a worst case scenario. The best outcome in a best case scenario is that it'll be treated as a lump sum, the individual will be over 60, and it'll be treated as non-assessable, non-exempt income, because the ATO can see that the trustees didn't take deliberate action to fail to pay the minimum. There was some underlying circumstances that have resulted in it. And so really where we sort of land is that it's going to come down to how the commissioner chooses to use their discretion. And part of the withdrawal was that a lot of the feedback about these documents sort of didn't go far enough, particularly for self-managed superannuation funds. So it showed the capacity for, say, an APRA fund to make an error with a TRIS more so than a self-managed super fund. But of course, banking errors can occur across the board. So there are going to be circumstances where the commissioner will exercise their discretion, and then there's going to be other areas where clearly they're not going to. And really, I've put a lot of this information in the slides for you to be able to go away and read it, but to recognise that right now we are in a bit of a limbo with regards to early access, particularly for failing to pay the pension in a TRIS, because we don't have a definitive position from the ATO. So it's a key area that we certainly need to be mindful of. But what they are going to look at is, things that people have tried to do to rectify the situation. One thing they'll say is if you try to rectify it by putting the money back in, then you may put yourself in a position of being a benefit payment and a contribution at the same time. So, by putting it back in, if you've already maxed out your contribution caps, you could be putting yourself in an excess contribution problem. So if you've got clients who have found themselves in a position of not satisfying the pension standards, and so therefore have this early access. My advice would be, and I don't use the word advice lightly there, but my advice would be to reach out to the commissioner first to take action rather than try and fix it by putting the money back in, because you might double up on the problems that the fund has created for itself. So ultimately, with anything to do with benefit payments, we just got to understand the basics. We can take lump sums, we can take income streams, and we can take a combination of both, but it's going to be subject to the various condition of release that we've actually met. Taxation is going to be applied based on the age of the recipient or the deceased and the circumstances related to the condition. Terminal illness, no tax. Temporary incapacity, full tax, because it's not a legit income stream as far as super is concerned. And then, permanent incapacity, you've got things in between where you've got your disability super income stream, you've got an offset on one side and a modified tax-free calculation on the other. So all these sorts of things mean it's really crucial that we understand what the requirements are, and noting that when we get things wrong, there can be serious consequences based on the circumstances behind the issue. So that brings us to the end. Next 3 webinars, the next 2 webinars, definitely. I've been putting up here revisiting Div 296 because we haven't had anything legislatively, and there's an expectation from an industry point that maybe we'll see something in the next Parliament sitting, which starts next week. So it might start on Friday, I'm not sure, but it starts very soon. Are we going to see something then? So I want to give a bit of breathing space with the hope that we do have something on Div 296 later in the year. So next month, I'm going to revisit our non-arm's length expenditure because we've got our rulings there, and that legislation has now been in place for a solid period of time, and it's time for us to sort of make sure we understand that completely. Hopefully then talk about Div 296 in October. If it's not out then I'll rebalance for all of those sessions as well. So thanks for joining me today. As always, if you've got any questions, just chuck them in the Q&A box, and I'll look to answer those. Otherwise, SuperGuardian will send you out your CPD certificate once I've sent through the information with a copy of the slides. So you'll get a copy of the slides with your CPD certificate. Otherwise, take care, and I look forward to catching up with you all in our September webinar.